Debt funds can save investors staggering amounts of taxes while earning regular income. When compared to the more popular fixed deposits, the tax savings over an investing horizon of 30 years can stretch into crores. Yet, risk-averse investors continue to focus on the Section 80C benefits where the tax saved is a mere fraction of what investors can save by switching to debt funds. In this video, we will show you how a retired couple does just that and saves huge amounts in taxes. The story in a nutshell is as follows. Arvind and Rajshri Mehta are a retired couple who have a corpus of 3.6 crores and annual expenses of 12 lakhs. When projections of the expenses are made over 30 years, it turns out that if they stick to fixed deposits, they will not be able to leave any estate, being left with a paltry 10 lakhs after 30 years. However, if the couple shifts to debt funds, earning the same yield of 7%, the projections show that they will be able to leave an estate of 3.7 crores. This massive difference in wealth of 3.6 crores, identical to their starting corpus, is no coincidence. It is the result of the way capital gains are taxed in India. The rest of this video will explain this simple story. Debt funds are instruments that invest in bonds, certificates of deposits issued by banks, and commercial paper issued by companies. These schemes do not invest any portion of their funds in equity or equity-related instruments and therefore are not influenced by fluctuations in the equity market. The reason debt funds are so popular with retail investors is that you get a tax arbitrage opportunity by investing in them if your holding period is more than 36 months. Moreover, even if you withdraw the interest component before 36 months, the taxation is favorable compared to fixed deposits. The benefit of this tax arbitrage can be quite huge for investors who are earning a good portion of income through interest. In short, debt funds save huge amount of taxes by allowing you to defer taxes to the date of sale and by providing you indexation benefits. These tax savings are huge. They are easily 10 times the amount saved by investing under Section 80C. For an investor in the highest tax bracket, the tax advantage of debt mutual funds works out to a saving of 66% on their total tax outgo. These are huge figures. Let's take a case study of a retired couple to understand the benefit in rupee terms more clearly. The Malhotras, Arvind and Rajshri, are a retired couple. Mr. Malhotra worked in the Merchant Navy and has accumulated a tidy nest egg of 3.60 crores. The only source of income of the Malhotras is the interest on this corpus. Mr. Malhotra has been investing the entire amount in bank fixed deposits. To take care of his expenses, he withdraws 1 lakh rupees per month from this corpus, increasing this amount by 6% every year in line with inflation. The interest on this bank fixed deposit at the rate of 7% annually works out to 25 lakh rupees a year. Since the income is much higher than the expenses, the Malhotras feel quite comfortable with the income but are unhappy with the taxes they are paying on this product. It is generally not a wise decision to put all your money in one asset class, as covered in our video on asset classes. However, since this is a video on tax saving, let us consider what would happen if the Malhotras replace their bank fixed deposit with debt mutual funds. Debt mutual funds are generally considered better products than fixed deposits due to their diversified portfolio, tax benefits, as well as professional management. However, let us assume for the sake of argument that both products provide 7% nominal returns or 1% above the rate of inflation, which is 6% throughout this period. To ascertain the better product, we need to do a detailed cash flow analysis and check the closing balance under two scenarios, for example, one with debt funds and the other one with fixed deposits. Here is where a pleasant surprise awaits the Malhotras. If they shift their corpus from fixed deposits to debt funds, the closing balance after 30 years moves from a mere 14 lakhs to 3.78 crores. In other words, if the Malhotras stick to fixed deposits, they would not leave an estate. But if they shift their corpus to debt funds instead, they would leave a sizable corpus. But how is this possible, you wonder? Isn't the interest rate on both the fixed deposit and the debt fund the same? Then how could the difference between the two scenarios be a massive 3.64 crores? This difference is in fact bigger than the starting corpus itself. We will go through the astonishing result in the rest of this video. But first, let's understand what has happened in a nutshell. By investing in debt funds and only withdrawing their monthly expenses, the Malhotras have been taxed only on their withdrawal. This compares favorably to fixed deposits where you are taxed on the accrual of income, whether you withdraw the same or do not. So this is the first big tax benefit of mutual funds. You are only taxed on withdrawal and not on all the accrual. The second benefit is that for long-term withdrawals, you get taxed at a concessional rate of 20% versus the slab, which could be 30% in many cases. The third benefit is that you get indexation benefit on debt funds. So you must be wondering, what is this indexation benefit? Well, indexation allows you to adjust the purchase price upwards by the rate of inflation. This adjustment reduces the amount on which tax has to be paid. Due to these three tax benefits on debt funds, some tax is permanently saved while some tax is delayed. It should be noted that when tax is delayed, the money which would have gone out as tax is allowed to grow undisturbed. Let us go into more detail. In the first year, on the fixed deposits of 3.6 crores, the interest at 7% would amount to almost 26 lakhs. The entire interest would be taxed. Let's assume that the investor opts for the new tax slabs, which are fast becoming the default rates. The tax on this interest would work out to approximately 4.74 lakhs, presuming the investor has no other income. Let's go through the same exercise for the debt funds. The investor would only need to redeem a limited number of units to cover his expenses and the tax liability. When all the calculations are done, it turns out that the investor has a tax liability of only 27,500 rupees. This can be intuitively understood in this manner. In the first year, the investor would withdraw 12.25 lakhs worth of units. However, the investor is not taxed on the full withdrawal, but only on the capital gains on the same. Since we know that the capital gains are only 7% of the invested amount, therefore, the capital gains would work out to approximately 80,140 rupees. The tax at the highest slab, which says, would therefore work out to approximately 25,000 rupees. In other words, instead of paying a tax of 4.75 lakhs, the investor would pay only a short-term capital gains of 25,000 rupees, a saving of 4.5 lakhs in the first year itself. This same process would continue and the taxes saved and deferred would keep growing the investor corpus. The cumulative tax in the case of fixed deposit works out to 1.38 crores versus 64 lakhs for debt funds. Now, a new question arises. You must be wondering that the difference between the two corpus is a massive 3.64 crores. So how come the tax saving is only 74 lakhs? Well, it is quite simple really. The rest of the saving happens because the taxes deferred continue to grow with the investor. This can be seen from the fact that the fixed deposit investor generates an income of 7.41 crores on his initial corpus over 30 years, while the debt fund investor generates 10.27 crores over the same period due to the taxes being deferred. To conclude, the Malhotras save 74 lakhs in taxes by opting for debt funds instead of fixed deposits. As these savings continue to grow with the Malhotras, they add another 2.86 crores to their corpus, leading to a total savings of 3.6 crore. It should be noted that these savings are the future value after 30 years and are worth much less in today's value. This concludes our video on tax savings in debt funds.